This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to Trade Flow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Wednesday, June 17th, 2026. Yesterday, the market tried to figure out what the new post-peace baseline looks like. Today, the physical reality of moving atoms is aggressively overriding paper algorithms. The global commodities complex is officially in a super cycle divergence. Let's get you caught up for the opening bell. First up, the 60-second commodities flash. Notice Brent's maritime traffic jam. The post-peace oil plunge is over. Brent crude is slowly grinding higher, reclaiming the $84.50 a barrel level this morning, with WTI pushing past $81.20. The paper market priced out the war, but physical traders are waking up to a massive maritime traffic jam at the Strait of Hormuz that will take months to clear. Meanwhile, copper reaches unobtainium status. Industrial base metals are going parabolic. LME copper has smashed through resistance to trade near $13,720 per ton. Global smelters are effectively out of raw concentrate, and the AI data center build-out refuses to slow down. We are entering a genuine physical vacuum. Silver outperforms gold. While COMEX gold continues to chop sideways around $4,310 per ounce, silver is catching a massive bid near $64.50. Silver's dual role as a monetary hedge and a critical solar and electronics industrial input is giving it the edge. Finally, the agflation creep continues. Agricultural markets are locking in the USDA's recent WASDE shock, with U.S. hard red winter wheat supplies severely compromised and total output slashed to 1,543 million bushels. Domestic food processors are panic buying physical grain to secure their Q3 inventories. Let us take a deep dive into why the physical constraints of shipping and mining are violently reasserting control over the global economy. The data confirms our thesis. You cannot print physical commodities. Smart money is heavily rotating into hard assets characterized by structural deficits. Look at the Hormuz hangover. Don't let the peace deal headlines fool you into shorting energy. The diplomatic ink is dry, but the physical oil is barely moving. Maritime insurers are completely overwhelmed by the backlog of commercial vessels attempting to re-enter the Gulf. Expect rolling, localized fuel premiums throughout the summer. This brings us to the copper unobtainium squeeze. Copper is no longer just a housing proxy. It is the physical backbone of the AI revolution. On the supply side, we are seeing negative spot treatment charges, meaning smelters are actually paying miners a premium just to get their hands on raw ore. On the demand side, hyperscalers are laying thousands of miles of high-density grid infrastructure to power the next generation of AI server farms. At the same time, monitor the stealth agricultural crisis. The soft commodities market is quietly building a secondary wave of structural inflation. This localized harvest deficit guarantees that grocery store prices will remain highly elevated, which means central banks will be completely paralyzed. Here's the trade flow take. We have officially entered the era of the physical deficit. Paper treaties do not magically transport oil. Maintain heavy accumulation targets in industrial base metals, specifically copper and silver, and ensure your portfolio is hedged against agricultural inflation. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.